My name is Yanida Villanueva, and on behalf of FIBA, I would like to welcome you to today's FIBA webinar entitled Derisking, the Impact on Wealth Management. As we get ready to begin our webcast today, we would like to invite you to attend the upcoming 2016 FIBA Wealth Management Forum on May 5th through the 6th, 2016 at the Ritz in Coconut Grove. The theme for this year's forum is Transformation and Opportunities, the Consolidation Conundrum. For more information, please visit www.fibawealthmanagement.com. For those attending today's webinar, we are offering an exclusive savings of $100 to register for the Wealth Forum. The discount code is FIBA Webinar. And now I'd like to introduce our speakers. Isabel Wheeler. Isabel is the founder of Wheeler Consulting and has been a leader in international private banking for more than 30 years. During that time, she has been involved in every aspect of wealth management at some of the most well-known financial institutions, including Citibank, Chase Manhattan Bank, Banco Santander, and BNP Paribas. Her career progressed from relationship manager, covering clients from virtually every region of South and Central America, to investment advisor, and eventually director of product and services. She concluded her banking career as director of marketing and sales, supervising the activities of a team of relationship managers. Isabel received a BA with distinction from the University of Virginia with a major in concentration in Latin American studies, and she received a Chartered Financial Analyst, CFA, designation and currently holds FINRA's licenses 4, 7, and 24. She has been an active member of the board of Florida National Bankers Association, FIBA, for many years, and is the current chairperson of the Women's Leadership Committee. Previously, she was president and board member of CFA Miami. Isabel was named one of the top 30 most influential private bankers by Terrapin in both 2013 and 2014, and was recognized as one of the women leaders by Negocios magazine in 2014. She's been a panelist and speaker at industry conferences sponsored by FIBA, Terrapin, ACAMS, Latam Markets, among others. Stanley Foodman is CEO of Foodman CPAs and Advisors. Mr. Foodman has extensive experience representing U.S. and non-U.S. taxpayers with U.S. and cross-border tax reporting and governmental controversies. Mr. Foodman uses his law enforcement background, extensive experience as a forensic accountant, and expert witness to represent clients in resolving their tax controversies. He has represented numerous U.S. taxpayers through the U.S. Offshore voluntary disclosure programs. Mr. Foodman, along with his team of CPAs, also represents clients with a full range of accounting and tax services, including corporate and individual taxation, estate and trust taxation, wealth planning, and banking regulatory compliance. Foodman CPAs and advisors consistently rank as one of the top accounting firms in South Florida, with offices also in the Caribbean, Central, and Latin America. Foodman CPAs and advisors represents individuals and businesses from around the world, including the United States, the Caribbean region, Latin America, Europe, and the Middle East. Isabel and Stanley, the audience is yours.
Thank you very much, Anita.
Thank you.
And welcome, everyone. We're so happy to be able to talk to you today about a subject that is so much in the news. So I am going to start by asking you, Stanley, what is de-risking and how is the impact being felt in the U.S. and internationally?
Well, de-risking is a type of behavior that's being engaged in by financial institutions who are exiting relationships with other banks because of the push by regulators for a risk-based approach, and it has certain unintended consequences that it is creating. It's creating account closures, which are going to have an impact on U.S. exports and imports, and banks, of course, make a cost-benefit analysis regarding the accounts they decide to keep. It is going to create greater obscurity and less transparency. And you don't have to be transparent if you don't have to have access to U.S. banks. I believe that it may actually have some effect on the issue of whether or not banking havens continue to exist as they have in the past.
Well, one of the things that we're seeing is a huge reaction from some of the places that are currently in the forefront of being de-risked, such as the Caribbean. In fact, I think we have a quote here from the, can you pass the slide?
Yes, of course.
From the Prime Minister of Antigua and Barbuda on de-risking. He says, if there were any schemes designed to destroy the economies of several countries without a military war, then this is such a scheme. It is erroneous, it is pernicious, it is vicious. That's a pretty strong reaction from him.
Well, and my practice, we represent a significant number of banks in our region, meaning Latin America, Caribbean, and we have been getting a lot of requests from our clients who are being de-risked, that is, banks that are losing their correspondent accounts, and it is having a really devastating effect on their economies. It's getting to the point where in some countries, the central banks of some countries have asked the U.S. Fed to allow them to act as the clearing bodies for their own banks within their own countries because they no longer have access to the U.S. financial marketplace.
That's pretty strong stuff.
Yeah, it is, and it's for me, it's frightening because we have banks that are asking us the same questions. How can we get back, or how can we reacquire correspondent banking relationships or not lose our correspondent banking relationships because we're being put on notice by our U.S. correspondents that they're considering de-risking us or have already de-risked us.
So one of the effects that you're seeing and what they're saying is that the efforts by the regulators to increase regulatory scrutiny is actually having a perverse effect and creating a more obscure and less transparent world.
Well, I think from the perspective of U.S. tax collection, I think that banks that don't have U.S. correspondent relationships will feel less obligated to want to participate in worldwide transparency efforts such as FATCA or CRS. The feedback that we're receiving is, why should we want to participate if we can no longer have a correspondent account in the U.S.? It's causing a lot of consternation and a lot of fear.
Well, and unfortunately, going to the main topic of this webinar, it's also having a big effect on traditional wealth management, unfortunately.
Yeah, I'm wondering what it's going to do to wealth management, actually.
Well, I think we're going to see an acceleration of what's already happening, which is the consolidation of the offshore wealth management business. I think we have a graph of, this is a graph showing some of the M&A deals for wealth management firms. Now, this isn't just banks that are exiting the business. This is also reflecting, some of the M&A, but we can see that from 2008 through the end of 2014, in every region of the world, we're seeing major M&A activity in wealth management firms. So there are fewer and fewer players in wealth management. And so that's having two effects. First of all, the banks that stay in have a more ability to raise their minimum thresholds, to raise the costs of servicing these clients, because obviously as the correspondent banking aspects get more expensive, that's going to increase the cost of wire transfers and all the rest of that. And in fact, a recent McKinsey report showed that the top risk to growth for wealth management industry is heightened regulation. So most of these firms are consolidating or leaving the business in part because of the concerns about regulation. But in addition to fewer players and higher revenue, this is also debanking or taking away the opportunity for banking for a lot of individuals who normally would have been in this industry. So we're seeing a lot of firms who will no longer offer, we call them wealth management services, but I mean any type of banking services to individuals with balances below a certain threshold. We used to think that $1 million was the magic number, and in fact I think technically that's still the definition of private banking for most of the regulators, but most of the important institutions no longer want to provide individualized, specialized wealth management services to anyone with less than 5 million, and the threshold is moving up to 10 and even 15 million. So there are hundreds, probably hundreds of thousands of individuals who are no longer going to have access to someone to offer them these services.
Well, clearly what's going to also happen is the flows of money that they receive, from which they live and from which they have funds available for investment, are going to diminish, because if they're receiving an income stream from the United States and they can't receive it anymore because they no longer have correspondent relationships with the U.S., they're going to get driven out of this marketplace. They're not going to have the income streams from the U.S., and it's going to have a negative effect on the value of the investments that they have, because they're going to be selling at perhaps prices that they would not normally have to sell at.
Oh, well, that's absolutely going to be the case. I think we have the next slide shows the, oh no, sorry, if we can go one more, and we'll get back to this one. This slide shows the percentage of foreign ownership of U.S. assets and the percentage of U.S. ownership of foreign assets as a percentage of U.S. GDP. So if we look at the top line, the blue line, the foreign ownership of U.S. assets in 2014 represented about 20% of U.S. GDP, which is about $20 trillion. That's, trillion with a T. So if all of those people who are, or if a significant portion of those are no longer able to own U.S. assets for whatever reason, and we're going to talk about mutual funds in a little bit because I think that's a whole nother ball of wax, as they say. But if even a fraction of those feel the need to sell what they have in order to repatriate their assets so that they can use them, that's going to have a pretty serious effect on the U.S. markets.
Well, it's going to be interesting because if they do have to sell them, but they can't get their money out of them in order to repatriate their money because they have no correspondent relationships in the United States, we may be seeing people walking out of the United States with cash, which clearly the government doesn't want. So it's creating a potential for a bubble in a whole different sector of the economy than what was affected in the previous cycle of bubbles, which was real estate. And in fact, a lot of these investments also affect the real estate industry as it exists today because of the limited partnerships and the other issues that come up.
Right. Well, when you talk about people potentially having to go back to cash, part of the problem, they're not going to get their cash from their traditional, large multinational bank because they're not operating in cash anymore. So what does that mean? That they're going to have to get driven, say, underground to transactions that, to selling cars for cash and their jewelry for cash? I mean, it seems it's really creating a situation where the attempts to bring everything to the surface where we can see it are going to be driven to places where people can try and get their money.
Well, yeah, I mean, look, water always finds a level, and when you have a leak, it's going to find a new level to go to. And if the only way that they can get cash, because nobody keeps large amounts of cash anymore on hand, as you said, they're going to have to find a situation where they can get their cash to get it out of the U.S., to get it back to their countries, into their marketplaces, which I know we're going to talk about later, could create a local feeding frenzy and have an even greater negative effect in their local markets for their own investments.
Well, before we finish talking about what's happening in the U.S. and move to overseas, there was one other point, and I think we can skip back to the slide before, which is what's happening to local community banks.
Well, they're being destroyed at a certain level. A lot of smaller community banks have attempted to have their own investment departments, that is their own investment banking, small departments for their customers. I've been approached by several, I'm sure other people have. And once again, a lot of this runs through the larger banking sectors. And if we're dealing with non-U.S. investors who have accounts in U.S. banks, who otherwise would qualify to have those accounts, and if they're being driven out of the marketplace because their money is not obtainable anymore, their funds are not obtainable, they can't be transferred easily, we're creating a huge amount of friction and freezing the system. So I think it's going to cause a consolidation in the banking industry.
Yeah, this graph I think is really interesting. It's showing the blue line is the percentage of assets by bank for the top 5 largest banks, and then the green line that's heading down is community banks.
That's right.
And they've really traded places. Community banks back in the 1990s had over 40% market share of assets, and now they're down to 18%.
Well, what's interesting to me about this graph, besides what we're discussing here, is that the U.S. government has been requesting the banks to lend back to the real estate industry for people to buy homes. A lot of those loans traditionally came through community banks, but if they're having a smaller and smaller share of assets in deposits, how are they going to lend? I don't see how they're going to do it. It's going to be more and more difficult. They're literally going to become basically retail banks. Take deposits, write checks. I don't see what else they're going to be able to
But they
do.
have to be able to fund their deposits with something. I mean, the only way they can take deposits is if they can make loans as well. So where are they going to lend money?
Or the cost of banking for smaller consumers has to increase significantly in fees.
That, I think, is probably the more likely.
Yes.
The more likely. Well, going back to the issue of account size and let's take a look at what's happening overseas. We're seeing, I think this graph is a little bit further on. If we can just go back to here, this would be great. We are seeing that many of the smaller clients who are no longer being banked in the U.S. are going back to their home countries. And by going back to their home countries, they're creating an opportunity, actually, in some cases a very interesting one, for local institutions to step in and start offering them services. But, you know, I've worked with a couple of these banks as they're doing this, and they all want to be able to offer what we consider to be traditional wealth management, which means they use their local institution to offer the checking, the deposits, the savings, and in some countries, you know, interest rates are very interesting, so they can use their own deposit base as part of the fixed income component of a portfolio. But when it comes to other traditional assets like stocks and bonds, their markets aren't broad enough. They don't have, you know, a market of 500 equities. Maybe they have a market of 3 players. Their local banks, their local corporations that issue, maybe they have a handful of corporations at issue, but technically none of those are investment grade. So we're seeing a situation in which the local institutions are unable to offer their clients a suitable suite of investment products.
Well, I also think it's safe to say that the definition of investment grade may shift from region to region and from geographical area to geographical area. So there are a lot of countries in our region that have bolsas or stock markets, and I'm not. We don't have that here, but I'm willing to hazard that the offerings from their local economy are significantly different than what we offer in this country, and that the due diligence perhaps that's being done in evaluating these particular products for offering to the public may be different and distinct from what we have here. And so when we talk about investment grade, it may be a little different. And what's happening because of because of the reduction of correspondent banking or the de-risking is that it can cause a fallback to a different quote unquote quality of product. Or something that is evaluated under a different set of standards than what we have here. And one of the reasons that a lot of folks come here is because the mixture of the basket allows them to get a certain level of safety that they may not feel they have in their home countries.
Well, there's certainly the question of safety, but it's also a question of really kind of a traditional suitability issue, that if you don't have an appropriate mix of assets, or even if you don't have enough of the same type of asset to get rid of systematic risk, unsystematic risk, and just stay with systematic risk, you know, you need to have enough variety to be able to build that. And so if you have had to close your wealth management account in the U.S. and are relying on whatever is available in your home country, I mean, if you're European, you're probably okay, because obviously Europe has, you know, fairly broad and deep markets. But if you're from Latin America, this can create a situation in which you don't have very many options for investing, and that is a big problem for the subset of, or it's a major subset of wealth management clients who don't meet the $10 to $20 million threshold.
Well, I think there's something else, and that is the U.S. currency. The U.S. dollar has traditionally been the quote unquote reserve currency of the world. But if nobody has access to it, if folks don't have access to it, how does it maintain its position as the world's reserve currency for purposes of safety and investment?
Well, that begs another question then, Stanley. Do you think there's any possibility of the euro becoming a reserve currency for some of these countries? The European Central Bank, until now, and that could change, has not had the same sense of jurisdictional reach, or some say overreach, that the U.S. has for any transaction that takes place in dollars.
Well, the reason I brought that up deals with the concept of correspondent banking and the passage of money. Most of the wires of the world pass at one point or another through the U.S., even if they're going into euros and into the eurozone, or out of the eurozone and back to this region. How do they do that? we're talking about literally a systemic change in how money flows throughout the world. Now, whether the euro is going to become a reserve currency is anybody's guess. I don't know. But I think we're talking about the law of unintended consequences here. And I think that they're a lot broader. The unintended consequence may be a lot broader than what our regulators in particular have considered as all of this has been imposed on the U.S. banking system. I mean, this is the concept of knowing your customer's customer, or having knowledge of something that you can't easily have knowledge of. Very difficult. I don't see how this can be done in any efficient way. It's very, very difficult without a complete restructuring, culturally and educationally, of the entire banking system of the world, effectively, to come into U.S. standards.
Well, I mean, to U.S. standards, but the standards, it seems that like you said, the unintended consequences are that we may end up with less transparency rather than more.
Absolutely. I completely agree.
Well, we've talked a little bit about the access that wealth management clients are going to have and the consequences that might have on the overall product mix. But let's talk about some specific products. Now we can move to this graph here. You mentioned in one of our conversations, Stanley, that you're seeing a huge increase in appetite on the part of some of your clients for alternative, or what you call asynchronous investments that aren't related to traditional markets. Before you speak, I just want to point out what this graph is showing is the increase in global assets. Each bar represents the global assets, with traditional investments at the top and alternatives at the bottom, alternatives including exchange trade, real estate, hedge funds, that kind of thing. And the growth rate of alternatives is double that of traditional assets. So what are you seeing with that, Stanley?
Well, what I've seen happen, and because I represent some alternative investment vehicle companies, is that the rates of return, well, first of all, there's always risk, and that's part of the documentation of all of these investment opportunities as required by U.S. law and other jurisdictions in terms of the private placement memorandums and other documentation that have to be met. But what I'm seeing is that these funds are growing in almost geometrically at times. Funds that started off at $4 and $5 million 4 or 5 years ago, tiny funds, are in the hundreds of millions of dollars now. And the reason is the returns on investment that they can offer because of the nature of their offering. And it's not that their offering is unsafe or is risky or is any kind of a scheme. These are real offerings, and since they can't get the returns of investment in the banks that they used to get through these normal vehicles, through the normal fund methods and other things, they're going into these limited partnership vehicles. Now, in Global Radar last year, there was an article that dealt with the concern of regulators about the AML function and policies and procedures of alternative investment vehicles with regard to who is investing, and knowing what the source of the money, and knowing whether or not all the funds that came in were coming from historically legitimate sources. So these things these funds are also having to ramp up their AML. It's going to cause additional costs, but because the rates of return are so much higher intrinsically, they're still going to be able to attract more and more capital. Now, when you lose correspondent banking relationships, then some of these funds which traditionally have feeder funds, offshore and domestic, may lose access to the offshore feeder fund structure. They may lose access to banking, on which the entire structure depends for the investment vehicle itself, because a lot of them are situs in foreign jurisdictions, and all of a sudden money might not be able to flow into institutions in those jurisdictions and back and forth from the United States, and that's a significant risk.
Well, and I would hazard that probably for offshore clients, for our offshore wealth management industry, virtually all of the types of structures that they'd be investing in are going to be offshore, because for for tax reasons, they're not going to buy a U.S. registered investment company.
No, of course, if they do buy a U.S. registered investment company and the types of returns are from tax exempt, if you will, assets. I don't want to get into the code section, but I think code section 871 of the Internal Revenue Code. And when our banks have the same issue, have the same thing, interest payments on U.S. savings accounts or U.S. banks to NRAs, non-resident aliens, are free of U.S. tax. Well, there's another section dealing with portfolio interest. So yes, that can occur. As long as that occurs, they'll keep having an attraction for non-resident aliens. There's a reporting burden, however, that's added on top of this, because as we all know in the industry, the NRA reporting requirements that are out there will be issuing these Form 1042S's and 1042s showing exemptions and no withholding. But even so, it's just adding more and more of a reporting and regulatory burden on the banking industry. And then if you add on top of that the loss of correspondent banking, it becomes a very dangerous situation, I think, for the entire world economy.
Well, not just speaking of the alternative funds. I mean, if we broaden this out even to look at the whole universe of offshore mutual funds, I mean, mutual funds traditionally have been one of the ways that smaller investors are able to obtain diversified portfolios. So let's say, Mr. Perez is no longer able to bank in the U.S. He goes back to his home country and still wants to buy a mutual fund. As of the moment, a lot of these companies are still distributing their mutual funds through international platforms, the Pershings of this world, et cetera. If you look at the kind of the logical extreme of all of this, at some point they're going to have to put a block on that as well, because how do those mutual funds know who their customer's customer is? They sign distribution agreements with an institution and rely on that institution's due diligence and AML policies.
Well, we have two. That's true. We have a couple of levels of this. One is are the new FATCA indices for knowing who your customer is and whether they're U.S. But the other is the AML CFT platform, and it's really virtually impossible to know unless they're looking into if we're talking about risk management, right? And they're using, for example, the OFAC PEP list for deciding whose money they're going to take, and they're rejecting money for that purpose. That's fine. They've done their due diligence. They don't have to accept the money. They're in less danger, but they've still got to get the money into the U.S. or out of the U.S. What the U.S. is doing, to quote Ayn Rand, is maybe unintentionally stopping the engine of the world in a way that was completely unintended. Completely unintended. I'm finding it, the more that we're talking about this in the last few weeks, as we plan for this, the more frightening it's becoming for me.
Well, I mean, at some point, the regulators are going to sort of wake up. And in fact, they already are seeing that and giving encouragement to financial institutions to continue to deal with offshore accounts and correspondent banks. I mean, there was the issue, I think, recently when they opened up relations with Cuba, who was going to bank the Cuban consulate in the U.S. And of course, nobody wanted to touch that. And we don't even want to talk about things like, what do you do for the legitimate marijuana growers and things like that. I mean, that's a subject for a whole different panel. But the regulators, at some point, they're going to have to back off of this. But how do they do that without giving up on some of the ground they've gained in getting compliance?
I don't know that they have to give up ground that they've gained as much as there seems to be a disconnect in the regulatory environment between what the regulators are taught in regulator school, so to speak, and what's encountered in the real world that we all live in. In a perfect world, this would work seamlessly, but we don't live in a perfect world. We live in a world that's imperfect because it's made up of human beings and they're not robots. And so at some point, I think there needs to be a meeting of the minds between the financial industry, which is the banks and the investment companies and the insurance companies and so on, mutual funds, and regulators throughout the world so that they can find a way by which a change in culture could occur that would be digestible for the industry as a whole. Because the direction it's moving in now is, if an institution takes a risk-based approach and does what they believe is reasonable under all the things that are published, and it turns out they've made a mistake, who's going to pay the price? It's that institution. So for the institution, unless the income stream that they're earning is enough to offset the cost of enhanced customer due diligence that we're talking about, or the KYC or the KYCC, they're not going to want to keep those accounts because they're afraid of the sanctioning.
Well, but we've seen in many cases where the fines are viewed, whether that legitimately or not, as a cost of doing business. But in fact, today's Global Radar had an article talking about how the pressure is up to hold compliance officers personally responsible. So rather than helping institutions increase their surveillance without having, you'd think that the focus should be on the process and not necessarily the outcome, and that's what the regulators say when you get them on a panel in one of our forums. But then when they're saying that the compliance officers are going to be personally liable if anything goes wrong, you're going to have fewer and fewer compliance officers out there.
Well, it's not only in that area. The area of professional service providers is another area. They're acting in a way as compliance officers with respect to their own clients' investments in the U.S. And so under the OFAC rules, there are no special requirements for professional service providers. For some reason, they're exempt, and I think that in most cases, rightfully so, because there's the conflict between attorney-client privilege and the issues of customer due diligence. I think there's a presumption built in that they are going to see to it that they're not engaged in any kind of business that the regulators wouldn't want them to be engaged in. On the other side of it, they're because of things like geographic targeting orders and other things, they're being looked at more closely. And the OECD has said that they believe that one of the weak spots in the entire system are professional service providers, whether it's attorneys, CPAs, or any other professional service provider who is being used as a methodology by the financial institutions as an acceptable conduit for information, or as an acceptable validation of information. That may change. And the whole issue with the Panama Papers may cause that to change.
Well, that's a great segue. We were going to talk a little bit about the Panama Papers. If I have a little cartoon up here, and I think that this cartoon reflects what most people think the Panama Papers is all about, which is wealthy tax dodgers. And there's certainly some of that. I mean, we're going to see fewer and fewer people using offshore structures as a means to hide their income and their wealth. But as we've discussed, that has a couple of consequences. One of them is they may look for different types of returns because their returns are going down if they have to pay taxes on it. But offshore structures are useful for so many other things. I mean, some of them, as we've mentioned, and there was a great seminar on the Panama Papers that Viva put on just last week.
Sure.
So if anybody's interested in listening to it, I know it's still available online. There are legitimate uses for offshore structures, and are we going to end up throwing out the baby with the bathwater here?
Well, maybe. I know that in certain countries, the banking industry is converting itself into a wealth management industry because the issue of offshore asset protection is being attacked so strongly by regulators. Different types of regulators, not necessarily for AML purposes, but purely for fiscal and tax purposes. I mean, if you think about it for a minute, a lot of these structures are reportable in different jurisdictions. Now in the U.S., of course, they're worldwide reportable. But now I'm seeing where more and more jurisdictions are requiring reporting on offshore structures for a lot of reasons. one of which is they want to know how the money got there in the first place. It doesn't matter what the jurisdiction is. They may be territorial taxing systems as opposed to extraterritorial like we have in the U.S., but the money got there somehow, and they want to know how it got there. And then to decide whether or not those are assets that they want to tax or otherwise impose their will on. So, I mean, I think that and by the way, I think that the whole issue of Panama Papers and the effect it's having is in terms of naming Panama that way is really very pejorative and unearned. I mean, because the fact is we can make shell companies in the U.S. every day. We have states that specialize in it.
And probably with almost as much lack of transparency as you have coming out of Panama.
Absolutely. So this is sort of a little bit of the pot calling the kettle black, but it has, if you've noticed, whatever you've seen about it has involved PEPs, right? PEPs, the types of individuals who are politically exposed. And so it's caused, for example, the resignation of the head of government in one country, and it's causing other folks to sort of push back and change what they're showing or what they're reporting. But at the end of the day, in other places, it's causing animosity directly toward the folks that expose these particular structures in Eastern Europe, for example. But I think that this is an unearned, in many cases, an unearned picture. I think that legitimate asset protection is legitimate asset protection. People put things in these structures to protect them if they consider themselves exposed or a good target for litigation and other things, and that's why they do that.
Well, and for non-residents, the legitimate use of offshore structures is to buy real estate in the United States, because we have a differential treatment for estate tax purposes for U.S.
Yes.
persons and non-U.S. persons, and it seems that if structures are a problem. I mean, I've worked in wealth management for a long time. I sat on the client's acceptance committee. If you have Panama company nominal shares or BVI or whatever jurisdiction, offshore company with nominal shares where the officers, directors, shareholders are all the owner of the account, and you know who it is, it's easy. But the problem is that most of the structures are more complex than that. And the really complex ones, the spider webs as they like to call them, today it's very hard to open an account with that type of a structure in a real wealth management firm. So a lot of these are buried in the branches in the retail offices. And so, digging them out of there, I think, is going to be more difficult. But if the U.S. really wants to address this, maybe they need to address the reasons why non-residents need to use the structures to begin with, and that would involve changing the way they apply the estate tax to non-residents.
Well, I think that the estate tax law in the United States for non-residents is a two-edged sword. It is designed to collect revenue because the lifetime exclusion on an estate held in the name of an NRA is $60,000, and for a U.S. individual, it's over $5 million in value. And the tax rate is 40%, so on the amounts above the exclusionary amount. So it's pretty prejudicial against the non-resident alien investor, and yet we want their money. So we make it very difficult for them to hold assets in their own name, which promotes transparency. And so we're promoting the creation of structures in order for them to protect these estates. Now, maybe we should sort of flatten that out and give everybody that benefit. I don't know what the answer is. I know that U.S. people are taxed in other countries on patrimony, but they're not necessarily taxed in a prejudicial way.
Well, we had the case that was very interesting in the last place that I worked of a French person who owned U.S. equities in his own name. He did not want to own a structure because of the impression that gave. He was a fairly well-known individual. So he held it in his own name, and upon his death, he had a potential estate tax liability. And eventually, after about 2 years of dealing with accountants and lawyers and all of that, he was able to actually liquidate his position in the U.S. without paying an estate tax because he offset it. There was a treaty agreement with France which allowed whatever estate taxes that he paid in France to cover that. And so, I mean, at some point those things will happen, but it's costly and it's cumbersome. And in the meantime, the easiest way is just to have, you know, Sunshine Corp, ABC, to hold your assets in so you don't run up against that problem.
Well, what I'm finding most interesting about what you said is the fact that the professionals who at the end of the day, after this person passed away, took their time, or didn't think, or something happened where they didn't look to see whether or not there was an anti-double taxation or an estate tax benefit between France and the United States. I had a case similar. My gentleman was Middle Eastern. We didn't need to deal with the treaty because his investment advisors had him in specifically in products which upon his death would not trigger an estate tax. They triggered a filing, but no tax because they were exempt
So
under U.S.
offshore mutual
regulations.
funds, basically.
They were actually in U.S. municipals of a certain type of municipal bond.
Okay.
The point is, I guess, is that, yeah, it's a very complex situation. We're in a complex world. We have a complex tax code here, and maybe we just be better off treating everybody the same way.
Well, before we open it up to questions from the audience, let me just ask you, Stanley, we talked about this. What are some potential solutions we can see for this? How can this be dealt with in a way that doesn't, you know, trigger, you know, securities Armageddon or financial Armageddon because the whole world grinds to a halt?
So I think that it's important for U.S. financial institutions to somehow be protected from the unknown unknowns. If they perform reasonable due diligence on a foreign institution, they should not be penalized if something unforeseen or untoward occurs, because otherwise they'll be stuck with sending an army of people to another country and have a very, very costly process, and their income stream from that relationship will not justify keeping the account. I think that we need to create a new compliance culture in non-U.S. banks if possible. Foreign institutions probably ought to ramp up their policies and procedures to meet the standards of U.S. institutions and maybe European institutions, because their AML standards are very, very strict now also. And I think what the other side of it is to that, and maybe we need to ask the U.S. institutions en masse, or the larger institutions that hold most of these accounts, what is it that you want? What are you looking for in order to be able to maintain these corresponding relationships? And then go through the process of educating the non-U.S. banks about this so that they can maintain their relationships. I think the regulators need to get on board also. I don't think they are on board. I think that we've sort of siloed different parts of our culture and our society. Regulators are in one silo, banks are in another silo, professional service providers are in another silo, and we're all talking at each other and not necessarily with each other. And I think we need to find a way to deal with that, because we need to recognize that the pendulum for compliance may have swung too far, and we may be looking at the bursting of a really unintended bubble, and it's very frightening for people like myself who do business around the world. I worry about how I'm going to be able to get paid. I actually wonder if I represent an offshore client with respect to U.S. issues, and they don't have a correspondent account to pay me through a wire transfer, how do I get paid? 40 years ago, and I'm old enough to think about this, I would go down to another country, and I'd have to find a way to get paid in the local currency, go to a local currency exchange house, change it to dollars, come back to the U.S., declare it at customs coming in, fill out a currency transaction report, and be completely inconvenienced at the airport. What do I do now if this happens again? I don't know, because I don't know how I'm going to be able to get paid. And I think that's true of a lot of my colleagues who I work with in the legal profession, other CPA firms, and other kinds of consultants like yourself. I mean, how are you going to get paid by your foreign clients?
I hadn't thought about that yet. But interestingly, I did get a call from my bank. I got a wire transfer from one of my clients in Panama, and I got a call from my bank saying, what do you do? Where did this money come from? What's it from? So that was the first time. I mean, I've gotten paid before, but this one I think that they're all starting to ramp that up.
So given that we still have correspondent accounts, right?
Right.
What I do with my bank, and I do this because I used to be in law enforcement for a period of time, and because I do consult on this, when I decided to re-enter, if you will, the international environment very, very strongly, I went back to my banks and I said, okay, it's time for me to change my profile. I'm going to be getting significant retainers in from foreign banks and from foreign taxpayers. And I want you to know why it's coming, so that when the comptroller of the currency comes in to do their audit, that you can explain to them why such a high percentage of what's coming into these accounts is coming in from offshore structures or offshore banks.
Right.
So that you don't have to file a SAR, a suspicious activity report, on me to both the state of Florida and the IRS, so that I'm not visited by two agents with badges asking me questions. I mean, this was my concern, and I think it's a legitimate concern. So I will say the same thing to you. Go in, this is what's a recommendation, go in and change, if you're going to be doing this, your profile with your bank.
Yeah, I think that's what the call was about. I think they updated. So do we have any questions? Here's one. I think this one is for you, Stanley. Why do you think there were so few U.S. persons mentioned in the Panama Papers?
Well, because so much of the U.S. marketplace that does this isn't necessarily made up of PEPs. So I know that there's ongoing investigations by various governments. And by the way, an article came out today about the G20 and how all of us in my industry have to be aware of what's happening with respect to fiscal transparency worldwide, and also AML transparency worldwide, because we haven't been looking at it. We've been too narrow. So a lot of the folks in these structures from the U.S. are not PEPs, so they're not going to make the front pages.
Right.
However, it does not mean that as the information is circulated and filtered into the U.S. regulatory body, if you will, the body politic of taxation and other things, that these agencies won't start investigations, which they cannot disclose because they're ongoing criminal investigations. They won't hit the press until there's a prosecution.
We were going to do some audience polling, right? Let's see if we get some information back, some feedback here from our audience. So if let's start with the first one. So you want to explain how they need to do this, Yanira?
Attendees, go ahead and select which one. The question for this poll is, how many are in wealth management?
How many of those attending are in wealth management?
Okay.
We're going to keep it open for about 10 more seconds. So results are 40% are in wealth management and 60% are not in wealth management.
Okay, well, of those that are in wealth management and those that are not, if you you can answer based on institutions that you know, how many of you have seen a drop in your NRA wealth management business?
It's already happening.
Yeah.
Leave this open for about 10 more seconds.
Yeah, that's an interesting result. So far there's still robust wealth management business out there, although some have seen that drop, but it's still it's still strong, and that's very positive, because I think that the regulators are starting to be aware of this, and I think they're looking to do something before that inverts and we see, the 60% have seen a drop in their business. The next question we have there, how many of you believe that de-risking is going to have a continuing negative impact in the future? I would love to get a screenshot of this and send it to our local regulators. And if you want to drive wealth management out of business, keep on doing what you're doing. That's very strong. Okay, we have just 2 more questions, but I think they're interesting. The next question is, how many of you have seen an increase in the use of non-traditional or asynchronous investment vehicles?
It's interesting.
Yeah. So there is definitely an increase, and I wish we had thought to ask, what level, but I would imagine that's coming from the higher level of the wealth management,
Yeah, and there was a follow-up I would have loved to have done, going back to the first question for a minute, which is as for those of you that have had a loss in your NRA wealth management business, or a decline by what percentage of your business?
Right.
We didn't follow up with that, but I would love to know that.
Yeah. And then the last question we have is, how many of you are using your investment platform for limited partnerships? Yeah, and I think that here, this is, Stanley, I had mentioned to you before, a lot of the issue with limited partnerships, I think people are not as aware of what the tax rules are. Most of us have the impression that if clients are invested in limited partnerships, that they may have to file a K-1. And you've mentioned that depending on what the underlying assets are, that might not be.
Yeah, sometimes there's a hybrid approach to reporting, but between 1042s and K-1s in the same entity. What I'm finding interesting about this is that even though 24% use them or allow them on their platform, the percentage of assets under management in limited partnerships or in asynchronous is going up. So a small percentage is doing it, but it's taking a larger and larger piece of the marketplace.
So let's see if there's any more questions here. So I'm going to throw this one to you again, Stanley. What are some of the solutions that banks can, that if you're a U.S. bank that has offshore, U.S. that's acting as correspondent for offshore entities, what are some of the things that you can be doing now to help protect yourself?
Well, and we've talked about this on the outside. I think that one of the things that the banks can be doing is using third-party teams, third-party entities, to assist with evaluating the policies and procedures, the written policies and procedures of their correspondents, and then to have them looked at from a practical perspective. That is, what are they actually doing, regardless of what's written in the policies and procedures, and determining from the results of those studies whether or not they want to keep or not keep a correspondent account. Now that's a good thing, I think, because it will impart to the foreign correspondent what's expected of it, and it provides a training opportunity.
Right.
And it also provides if the folks that are doing it have sufficient background and standing professionally, it provides and they provide the proper platform for this investigation that they're doing. It provides the U.S. bank with some sort of comfort as to what their offshore correspondents are doing. Now, it doesn't mean that there can't be a failing somewhere in the system, because all systems are human systems. but it gives them a way to go about doing
Well,
it.
and I think a couple of things you mentioned is important, is making sure that the people who look at this are sufficiently knowledgeable and have the level to really analyze it, because I would venture to guess that every single bank out there has policies and procedures that on the face would meet the standards. The question isn't so much whether they have the policies, is how they're being implemented and how they're being enforced and monitored. And so I think not just saying, do you believe that you should combat money laundering, yes or no? It's how are you doing it? What are you doing? What's the culture you're creating? Is there a wink, wink, nudge, nudge attitude from your board of directors, or is there really a top-down culture of compliance? And I think in order to look at that, you can't have sort of a junior person who has a spreadsheet that he's checking boxes on. You need to have someone who can really sit with the senior management and gauge their level of commitment to it, the level of enforcement of it. And that's really, I think, where the solution lies.
Well, I think that's part of it, but actually there's another piece, and that is it's not just sitting with senior management or even training senior management. It's how senior management trains the troops.
True.
It's getting down to the gatekeepers of the institution, the people that deal with the public on a daily basis, that deal with customers in their account opening situations and in their ongoing situations of account maintenance. I think this is very important. And so that's an ongoing, we're talking about ongoing training, continual ongoing training, because there's personnel changes. People come, they go. And we're talking about changing the culture of how, and all of these institutions, by the way, have training. It's not that they don't have training, but we're talking about adding a new dimension to their training.
We just have a couple of minutes left. I have one more question here. Let's see if we can get to this one and maybe one more. And that is from someone who's asking, if you are a U.S. institute, a bank in the U.S. that is an affiliate of an offshore bank, what is involved in you acting as a correspondent for your own institution? What are the rules on that, and is that something that's possible if you're not able to get other correspondent relationships?
Well, we've talked about that, and it's you and I and some of our associates on the outside, it raises the risk level for the U.S. correspondent. The U.S. bank, which is part of an expanded group of offshore of an offshore entity, because they're also a U.S. institution. And so we're talking about ramping up, if you will, U.S. side customer due diligence and filtering all of that down into the banks offshore, knowing that the regulators in the U.S. are going to be looking at the U.S. institution with a whole different set of lenses.
Well, I think that applies not just to correspondent banking, it also applies to wealth management, and there are a lot of there are a lot of institutions in the U.S. in Miami who provide wealth management services for clients referred from their own institutions, and I think it's very important for them to be confident that the local institution is following a process and has procedures and controls in place to make sure that they're not inadvertently creating a problem for themselves in the U.S.
Well, this came up with certain types of trust companies who were actually agency offices for offshore trust companies as to how they're going to be regulated in the state of Florida through OFR. It is an issue. It's an ongoing discussion. I think that, and those folks are involved heavily in wealth management, but it's not only for them. There may be other foreign institutions that are large that have come in and have their local offices. And I'm talking about regional institutions that actually have local offices and these are institutions that are quite large, becoming their own clearing companies for themselves.
Right.
And some of that exists already. Some of them are heavily involved in it, but for some of the smaller ones, it's taking on a whole new set of responsibilities.
Can we see the last slide then here before we finish up here? I think this one I thought was very interesting. We've considered every potential risk except the risks of avoiding all risks. And I think that's really where we're standing right now, that all the institutions have been so focused on managing risk that they don't realize that banking is by definition the business of intermediating risk. And at some point we have to find a way to be able to do that without getting in trouble with the regulators.
Well, we're really getting to the point, to quote my mother, may she rest in peace, of being in the position of possibly throwing out the baby with the bathwater.
Exactly.
And I don't think that that's what we want to be as a country and as an economy, nor do any of our friends in the region. They're trying very hard to have control over their own situations, and it feels like from the comments I get that no matter what they do, it doesn't seem to be enough, but they're not sure what enough is. And that's where that comes in. They don't know what the risk of avoiding all risks entails. They just have no idea.
Well, I know that this is going to be a subject for further discussion at the Wealth Management Forum. I don't know if you want to repeat the information about that before we sign off.
Yes, I'd like to remind everyone attending today's webinar that we are offering a discount, $100, if you decide to register. We just ask that you email us at wealthforum@fiba.net and enter the discount code FIBA-webinars to receive the discount. I'd like to thank you, Isabel and Stanley, and everyone for attending today's webinar. If you have any other questions, again, please visit FIBAwealthmanagement.com and we'll cover this topic and much more. Once again, I'd like to remind you of the discount. You'll also be receiving a follow-up email within 24 to 48 hours with a link to view today's recording and also a survey, which we appreciate if you complete. On behalf of FIBA and our presenters, and I'd like to thank you for joining us and have a great rest of your day.
Thank you.